Good afternoon and a very warm welcome to this latest New Entrant Network webinar. My name is Richard Angus and I'm Head of Business Development at Hardman Co. I'm delighted we've been able to organise today's event, and it's very good to see so many people of our regulars attending and also a number of new attendees. So on behalf of the Hardman team, I would first like to particularly thank Martin Fox and Paul Richardson for all their hard work. These events don't just happen out of thin air, and there's been a lot of preparation, so we're very, very grateful. So before I hand over to Martin, who has kindly agreed to chair the session, I'd just like to thank also our distinguished panel for agreeing to participate. You're very welcome. When we set up NEN just over 2.5 years ago, the purpose was to develop a community that shared the common goal of encouraging EIS to provide a forum for debate and to help foster new relationships. So I hope you will continue to support our initiative. We'd be very grateful for any suggestions or any feedback you can give us. You can either give that to Martin or you can give that to myself or one of the Hardman team. And I hope you enjoy the session. Now, before we go any further, could the panelists please all turn on their cameras and mics? And then I will hand over to Martin. Over to you, Martin.
Richard, thank you very much indeed. And thank you for inviting me to take part in this. It's great. Before we start, can I just say thank you for the turnout today. There's approaching 50 delegates, which I think is pretty good when we're all zoomed out, as I'm told quite frequently. I'm also delighted that despite the difficulties of this year, we have a very strong pipeline of new EIS funds coming to the market. Can I give my thanks to our outstanding panel who are giving up their time today and looking at the important issue of how do new or relatively new funds gain traction in the advisor market. Before I ask them to introduce themselves, can I just say that we would welcome questions from you. Please use the Q&A button and we'll try to answer as many as we can as we go through it. And if you could add, if you've got a particular person you'd like to answer the question, please nominate who you want to answer it. Right, back to our panel then. I've asked them to briefly introduce themselves, to explain what they do and what their interest is in the EIS market. So, tossing a coin, Avard, can I ask you to go first and introduce yourself?
Yeah, of course. So I'm Avard. I work with Tilney Smith & Williamson. I've just actually changed the name for my company on the Zoom screen. We merged actually a couple of months ago, so that's why it's getting used to the name. So what do? I head up the research for all tax advantage investments for the group. That includes VST, EIS, SCIS, IHT products, as well as keeping an eye on the SITR, actually hoping that the government will give that a new lease of life. I engage with all the financial planners as well as investment managers in the group and help them with their client conversations, as well as help them with selection of EIS, for their client portfolios.
Thanks, Avard. Can I just say, Avard's a fount of knowledge about all tax products. Is great to have on board. Safdar, can I ask you to say a few words now?
Hi, good afternoon. Pleasure to be on. Thank you for the invitation, Martin. I run Binary Capital here in London. It's an independent, I guess, investment family office, wealth management boutique. I run it. I lead in all areas of investments. When I say investments, we manage investments on behalf of clients, whether that's IFAs or families or ultra high net worths, around equities, fixed income, as well as alternatives, which is where the whole EIS, SEIS, and other alternative strategies may or may not come into play. And what we tend to do is we tend to take a very long-term approach to investing for clients. So we're very much patient capital investors, very much long-term as well, and concentrated. We don't like a lot of ideas in our portfolios. So we have often as less as 10 to 12 fund ideas in a balanced or a typical mandate in that respect, which is fairly low compared to some of our peer group. And we reach out to clients all across the UK and some internationally as well. We have some knowledge and interest around ethical or faith-based investing as well. And we're trying to bring that into the whole kind of EIS phrase and universe as well.
That's great. Thank you so much. Dan, how about you next?
Hi guys, yes, I'm Dan Rodwell, Chief Executive of Growth Invest. Just like to say thanks to Martin, Richard and the team for having us on today. Very excited to be speaking at another one of these events. Yes, Growth Invest, we are an advisor-focused platform that specialises in tax-efficient and alternative investments. So that covers the whole gamut of VCTs, EIS, inheritance tax products and other alternative investments. Ultimately, our advisor clients use our platform to invest and then manage client portfolios right across alternative assets. The point being that they can centralize this all in one place and it enables them to scale their business quite significantly.
Thanks. Okay, down to two. Boyd, you're next.
Hi there, I'm Boyd Carson from Sapphire Capital Partners. We would describe ourselves as investment managers, but in reality, what we do is we help an investment team set up or to create, set up and manage an investment fund. So we would work with a select group of individuals to launch investment funds. So to date, we have about 35 funds under management and about 100 million assets. And it's a diverse range of funds, from technology funds to robotics to spin out from universities. So we really kind of handhold funds through the whole setup, launching, writing the documents, going out to investors, and right through to hopefully exit in a number of years' time. We're based in Belfast. We've been doing it for about 10 years now, and we're very much focused on the SAS and EIS space, although we are now starting to manage other types of funds, including BR funds and the typical venture capital LP GP type funds. And that's what we do. Thank you.
Thank you. And second not least, Paul, you're last.
Thank you. Thank you, Martin. I'm Paul Richardson. I'm from the Share Centre. I'm head of sales there. The Share Centre has been in the EIS custodian world now for 18 years. And what does that actually mean? That means for our partners, the fund managers, we actually carry out the anti-money laundering on new clients and on an ongoing basis as well, making sure that they're either identified or not identified as PEPs, potentially exposed people. Then we look after the assets, which is either the stock and shares, which are the fund managers purchased on behalf of the beneficial owner, the investor, and also the client money. So the Share Centre was taken over and is by II, Interactive Investor, in July of this year. And altogether, the company has over 350,000 customers, approximately £30 billion worth of assets under administration as well, and is profitable. What I have and what I bring to the party for the actual team on the sales side is I have my EIS Advisor's Diploma. I've written articles on the exciting area of custodianship, and I've been a finalist in the EIS Awards and a judge in the Growth Investor Awards as well. So hopefully with all these things, I can bring a good perspective from the investors' point of view and also the fund manager's point of view, and also act as a centre of knowledge and excellence for them as well.
Okay, thanks ever so much. Can I just start with a fairly general question, a bit of background? It's been quite a year for EIS. If you talk to any of the funds out there, business fell off a cliff back in March. And it's been a year of change and uncertainty ever since. So how do you see the EIS market today? How's it looking as far as you guys are concerned?
From my perspective, we look after over 20 different fund managers. And as you quite rightly identified there, Martin, there was a drop-off at the end of March, at the beginning of April. But what we're starting to see is people are starting to come back to the market. financial advisors are finding ways to actually talk to their clients, and funds are starting to move back into the sector. And what it's taken is people to adapt to the new environment in which we're in. And what we find with investors within this sector, they do like the personal touch, and they do like to speak to their advisor on not only EIS but the whole of their investment portfolio.
Other views, guys?
Yeah, I mean, I can maybe concur in that. I think what's happening now is, as we're getting close to the year end, 2-3 weeks to go in terms of business, I'm seeing certainly some people already looking ahead, looking to 2021, whether that's with expansion plans, further share issues, new capital raising, whereas EIS, SEIS, or even normal capital raising. So certainly a couple already have come across my desk last week, and I've got a couple others that are due to hit my desk in the next few days as well around that. So it's looking positive going forward for sure.
Martin, from a creation of funds perspective, as in new funds being launched, we've never been busier. And
yeah, that's great. Yeah,
I think it's possibly, I've been trying to figure this out, why it is. It's possibly because during COVID, people have thought to themselves, oh, I really did want to launch that fund. We really did want to create that fund. Maybe we now have time to actually sit down and think about it and plan it out. So during the COVID period, we've been inundated with requests to launch new funds. Now, we haven't been inundated with investors wanting to invest in the new funds, but certainly from the launching of the funds, it's never been busier, which I think is a good sign, because it's indicating that there are opportunities out there to make investments, as into the investee companies, and people are recognizing that and saying this is a good time to start. Hopefully the market will come back from the investor's point of view, and there'll be good opportunities to invest.
yeah, okay. Avard, how are you seeing it? But you are muted at the moment.
Typical. I think for us, what we found was that because most of our financial planners would have done their planning with clients well before the 5th of April, we weren't that impacted by COVID in March, basically. So we were lucky in that way. So we actually maintained the same level of business that we'd done the previous year. So that was good. Beginning of COVID, quite, I guess, to be expected. Our financial planners were far more engaged with our clients around estate planning, around making sure that clients had wills in place, making sure that they'd had conversations with their loved ones about, all the things that were going on in the press at the time. Now, that's initial concern, obviously, is over now to some extent. Clearly, most of our clients now will have their affairs in order for the unexpected. And now the conversation has gone back to, let's talk about EIS, let's talk about VCT, and let's talk about doing more exciting investments than otherwise still, very good investments in renewable energy, etc. But in the IHT space, but it's back on the EIS now. And SEIS, we have had some clients starting to put money into SEIS already. So
that's very good.
That's a good sign.
Okay. And Dan, are you seeing flows coming in now?
Yes, yeah. I mean, I can echo what everyone said, really. You're quite right, Martin. Timing was very unfortunate in the last tax year. The current situation all came through in the busiest part of the year for EIS. So, whilst a lot of VCTs within our client base tend to be done earlier, there was definitely an impact to EIS. I think it's definitely taken a few months for this to play out, but over recent weeks and months, we're really starting to see a lot more interest coming in for EIS specifically, and a lot of advisors who are preparing, clients and doing suitability and so on and so forth, ready for, prior to tax year end 21. So I think it's really positive. To touch on Boyd's point, after a couple of weeks where there was an initial glut, if you like, we are busier than we've ever been, and I do think that advisors have used this time, to look at their tax efficient proposition and potentially work, look at putting in platforms and controls with a view to, really pushing this side of the business going forward. So really positive for the future from what we're seeing.
That's good. There's been one question fired in already, which I'm delighted with. Thank you. But someone said, look, with the US markets at an all-time high, with the stock markets over here doing very well the last 3 weeks since vaccination started to appear, isn't the confidence going to help people help? And will that encourage people to think of other investments? And I guess what you've been saying has sort of endorsed that. Would you agree that the confidence is there?
Yeah, I think for us, we've already seen clients, but in combination with obviously the market's doing quite well at the moment, but also with potential changes to CGT rates, we do have active conversations with clients about taking profits, with the view not necessarily obviously to roll that gain over, but to have an active conversation around, so I've taken profit now, what do I do, what can I do with my money? And so the conversation around EIS comes up immediately. Yeah, as well as conversations obviously about with clients, as I think for financial planners, especially on the call here, it's important to start talking with clients ahead of events that happen in their life. So we're already starting to talk to our clients about, so what's the impact on your EIS portfolio where you've deferred gains if in half a year's time or a year's time, whatever it is, if the CGT rates go up, what does that mean? Can we plan for that now?
Yeah, yeah. I mean, you've just given me a lovely intro to the next question, actually, because the media and Rishi Sunak has been all hinting that tax rises must come. And it could be CGTs flagged, obviously, but it could be other taxes as well. Do you think this will make or could make EIS even more valuable?
I mean, I'll come in there briefly. I think tax obviously is a big issue in that area in terms of capital gains, income tax. But what I'm seeing is increasingly tax is not the only driver. There's always opportunities beyond tax in terms of a product or strategy or proposition. So whilst we will see further tax rises next year, I mean, that's inevitable directly or indirectly. Notwithstanding that, if you leave tax to one side, it's all about the proposition, it's all about the strategy. If that fits in well, that, inevitably there'll be capital raised, inevitably there'll be money flowing into that fund or that asset in that respect.
Yeah, thank you. Which is from an EISA point of view, yes, that's the right answer. That performance should not be wagged by the tail of tax.
Yeah.
Yeah. So thank you. Any other comments on tax rises?
Well, I do think, as you say, yeah, the government needs to balance the books, and so there will be rises, and they will impact the higher net worth clients that tend to focus on tax efficient investments. So with the big assumption that they leave the schemes alone, or potentially even make them more appealing, I do think there is going to be a flow of more capital on the back of that over the coming years.
Yeah, I would echo what Dan's just said there. As long as those schemes are not tampered with or even made more attractive, there definitely will be a bigger inflow into them, because there's really very little places one can place your money in a tax efficient way. I mean, most other type of schemes have been closed down or removed. So EIS, SES and VCT are one of the few remaining endorsed schemes by the government.
Yeah.
And if I can just reiterate what everybody else has said, is that as long as the scheme's not actually interfered with or changed or amended by the government, it's not only the Chancellor of the Exchequer that was actually going on about tax rises, it was also the latest report which included CDGT about bringing that in line with income tax rates. So this makes EIS even more beneficial to people investing within these type of schemes.
Yeah. So the future is interesting. Thank you ever so much for that. I've now got one or two questions which I'd like to fire at Safdar and Avad, if I may, because they are really to do with the views of advisory firms. But please do pitch in others if you want to. But the first one is this: if a fund manager is new or relatively new, what can they do to get your attention?
Maybe if I can start briefly on that. I mean, what we want to see, we're an independent firm, we're small. We only invest in a limited number of funds for our clients, okay? So we're fairly concentrated in that respect. What we want to see when somebody comes to pitch up or present to us is what's the edge? Everybody needs to have an edge, some sort of edge on the product, on the strategy. Everybody talks about it in the pitch deck, but very, very few actually deliver such an edge, such a strategy. So it's all about going back to my earlier point about what is the strategy, what is the proposition, can they deliver that appropriately over time horizon and have that edge in that respect. I mean, in anecdotal terms, to give you an example, Martin, there's roughly 10,000 investment houses in the world. We, as a firm, want to look at the top 100, and we invest in 10 of those. So that's what you're competing against in terms of quantum, in terms of numbers in that respect. Just gives you a kind of idea around that. It's all about edge. Tell me the edge. Tell me where the value add is.
Thank you for that. I totally, from a marketing point of view, I totally get it about the need to have an edge. So I'm with you on that.
Yeah.
Avad, I'd love your views because we had a question in directed at you actually saying.
I saw that.
and saying, yeah, how can they get your attention? I mean, one of the things that I've been interested in, because I did some work for one or two companies where the people concerned have got a fabulous track record. They're very successful entrepreneurs, or they've done it before, but the fund itself they're now doing is new. Do you take any account?
So I think,
do you take any account of that?
Yeah, I'm not too bothered about whether a particular wrapper, especially around EIS, isn't 5 years old or something like that. I think the 5-year requirement that I have personally for the firm that I work with, that 5-year track record is a real hard line for IHT companies as well as venture capital trusts, as PLCs, as entities where with a proper track record or audits, etc., where I have some data on. With regards to teams, I would like the team to have been together for 5 years. And I'm not too bothered about whether they were investing in, I'm bothered about whether they've been investing in the relevant space. And this really comes out of the period where fund managers were just doing solar panels, say, and when the laws changed, suddenly they reinvented themselves and say, oh, by the way, this is a generalist approach now, and look at us, we've got this great EIS track record. I said, well, that's fine, but it's not a relevant track record. So teams that come to me and say, listen, we've got 5 years of, at least five years of track record. That's definitely a conversation. If you're on 3 years, let's start that conversation. Let's build that relationship. If you've got track record outside of the team that you form part of, let's see if we can make that some kind of auditable, audited or complied track record. If it is a fund that is managed by Boyd, for example, I think there's a role to be played by the fund manager in this case that can provide a verified track record. Because I
was actually going to ask Boyd to come in and to let us know what advice he gives to the funds that he's manager for in this respect.
I was very glad to hear that we can provide that role. But that was very reassuring, thank you. But to answer your question, for new fund entrants, I think the team is absolutely critical. And in ensuring that there's a breadth of experience and knowledge in that team. And it's probably why there is an insistence that, you know, it does go back a certain period of time, that there is consistency there. And we're looking for experience in actually making investment decisions, actually having exits, and managing people's money through a whole process. That's at least one or two people on that team have that type of experience. And then to add to that, there may be somebody on the team that has financial experience in keeping everything right financially, and even a bonus would be somebody who'd have some legal experience in keeping it right. So it's a whole package of the team. To your point, Martin, we have come across funds that have this incredibly experienced, maybe one person or two people that have done multiple exits before, but do struggle to raise money on their first fund. And the only thing that really matters at the end of the day for these funds is that they can actually raise money. Otherwise, it's a complete waste of time. It's very hard to advise them. My advice in that situation is to bring somebody on your team who has hopefully some sort of experience in EIS and SEIS funds that can help guide them. That would be my main thing.
And do you direct, you know, people do you bring people together for that, or do you leave it to them?
If I think there's a gap, I would help them fill that gap, because our success is bound up in their success. So we do not, under any circumstances, want that fund to fail. So we would typically help. But it's, you know, there are funds that I would think that are absolutely guaranteed to be successful because of the people behind it, and sometimes they just don't raise money, and it's very hard to work out sometimes what that exact reason is. It could be down to personalities.
Yeah. Okay. Thank you. Moving on, again, another question for Saftar and Avard. What sort of due diligence do you do on a product provider, a new provider? What do you want from them to satisfy you?
I think obviously for us, it's a number of things. Obviously, going back to the earlier point, looking at the track record, whether that's as part of the team, as part of separate individuals, as part of different teams. So looking at the track record, looking at the proposition, drilling down very granularly into the actual strategy and how it would deliver in terms of return. Looking certainly at the financials of the fund and the business itself, as well as the strategy, and going fairly, when I say due diligence, certainly meeting the team in person many times, spending a lot of time over the spreadsheets and the pitch deck, as well as that getting a sense check from others in the industry, maybe other competing strategies, other experts that are out there in that respect, or opinion farmers as well, around that, and building a whole 360-degree picture around the strategy, around the fund, around the opportunity that may present itself.
Okay. Avard?
Yeah, so it's definitely meeting fund managers. Obviously, it's meeting. Sometimes it's meeting with other people that maybe provide services to that team, if it's or to find out what the roles are that are played by some service providers to that team, whether that's dealing with a regulated fund manager, or whether that's dealing with finding out a bit more about which tax advisors they use to make sure that the tax advisors themselves are reputable, things like that. It's obviously also looking at the financial strength of the fund manager. It's looking at whether the fund manager is wholly reliant on managing that fund for their own income, and into that plays their ability to source, obviously, investments, their ability to manage investments. We look at whether the investment team are more focused on and this is more of I guess, the strategy they have. Some investment managers are what I would call financial investors, where some other managers are far more active in what they do with the portfolio companies. Are they the ones leading the rounds, or are they more passive? What's their involvement in the exit process? So again, you do need to have obviously track records to talk about. overall, it's a willingness of the team to cooperate clearly and to build a relationship. Yeah.
If I can just go, I'm sorry.
You go.
Yes, just to go on what was actually being said there before, it's about finding about the service providers. So if the custodianship is actually outsourced, whom are they actually using for that outsource? Because that's particularly important after the demise of Riker Securities in October of last year, where client money was being held and stocks and assets being held for over a year before they could be either released, or if when released, they could be invested. So that means to say that client money may spend over a year before it's invested, and people getting their EIS3 certificates to allow them to get their tax reliefs. So hopefully what's being done is a due diligence, not only on the individuals, but also all the service providers, including who's actually looking after their assets or holding the assets on their behalf.
Okay, thanks, Paul. Question that's just come in. Again, it's for Avard and Safdar, but I will move on to you other guys in a moment. But in fact, I've got two questions to fire at you. The first one is, is there a specific time of year that you actually assess funds and look to create panels, or your choice for this year? So what time of year is it, or does it vary?
And for us, it varies. I mean, there's no such thing as a specific date or timing. I mean, good ideas, good funds, good strategies come all the time through the year. So we don't limit ourselves to certain time periods to look at a strategy or fund coming in. It's very much the whole year. Ideas come as and when they come in. You never know. It could come in the last week of the summer, or it could come at the first couple of weeks of the new year.
Yeah, and David?
Yeah, so I obviously have different hats on. So one of the hats is VST research. As a group, we also have Best Invest as an outlet. And so there are times of the year when I'm focused entirely on VSTs, which is the current periods, clearly. The other restrictions, obviously, I have a requirement internal annual reviews of panels. And one of the reviews I need to carry out after the VST season is going to be IHT. And so that's a standard thing. And then basically January, February, I'll start looking at EIS again. But because we don't use EIS for necessarily 5th of April planning, I'm not too bothered about that. Now, normally, let's put that also in perspective. For example, this year we put a new fund on the panel that we'd already established a long relationship, or at least a relationship over several years. But because previously that fund didn't have the right retail permissions for our clients, we couldn't panel it. So when that changed, that requirement, we were able to fast track that process. So there are exceptions, clearly, but ideally, in a normal year, I will look at the EIS any time of the year, any time of the day, apart from VCT season, basically.
Thank you for that. I've got one other question. We invited questions beforehand to people who signed up, and yesterday I got a whole page of questions from one particular delegate. So Matthew, thank you for that. I mean, he want to start. He actually, when he wrote to me, managed to compare the EIS market as a complex beast and compare it to prog rock in the early 70s. Not that I remember it, of course, but I thought that was quite an interesting comparison. But I will paraphrase one or two things that he said. In a world where there is such growth and transformation in specialist sectors such as health tech, ed tech, data, and digital, why is it that advisors generally stick with old established generalist funds rather than look at more cutting edge and focused funds that are in tune with the latest economic trends? In other words, there's some specialist funds coming in that are very relevant and at the cutting edge of technology development, but they don't get the attention perhaps that they would like. Any thoughts and comments as to how they can do better or why that is?
Well, if I can jump in. Yeah. So I think it's a very good point, and it absolutely ties in to one of the big problems in the market, which is why this event is so successful. You know, the advisors that we work with only have a certain amount of time, you know, notwithstanding Safdar and Avard, but you know, they advise across a whole range of assets, and EIS is it possibly only 10% of the portfolio. As such, they look across the market and they see where the safe money can go, if that makes sense. And I think it's been made much worse over COVID, and we're seeing a lot of people, you know, focusing on the big name funds. You know, it is an issue for the startup funds, particularly in an exciting time like now, where specialists in technology in some of these subsectors could arguably outperform the generalist funds, but they're just not able to get access to that capital. So yeah, I think there's lots that the new funds need to do to get in front of those advisors, you know, force them to make time to see you and understand your value proposition. You know, work with platforms like us where we wholeheartedly back the new startup funds, and we want to put them in an environment where they're visible and their proposition can be read alongside some of the bigger names. But it is absolutely an issue in the marketplace.
Can I just add to that,
yeah,
most of the funds that we see coming, certainly within the last couple of years, have all mainly been very specialist funds. And maybe I'm wrong, but I've always thought that was to their benefit, in that I've always approached it that the market's full of generalist funds, and to stand out, you need to be a little bit specialist. And I take exactly what Dan's point of, you know, it's probably safer to go into a specialist fund from an investor's point of view, but it is quite a crowded market. So if you can be, I wouldn't want anybody listening to be put off a specialist type of fund if they're thinking of that. So because I do think that creates your niche. I mean, even today we were helping a fund launch, and one of the first questions from the platform that's going to host them was, you know, what is your niche? What is your specialism? That's what we really want to know, because there's plenty of other funds out there that are quite generous. We need to know why you're different. So I think it should still be regarded as a plus. And I would hate anybody to think they should shy away from being specialists if they have that expertise. Of course, they have to prove they've got that expertise.
Yeah. Thank you for that.
Add something, Martin, while we're on this topic. Just to add to Boyd's point, specialism is good. I encourage specialism. I mean, that's going back to what I said right at the start. That's where the value add could be for us when looking at a fund. But what's also interesting to note is this, in terms of investments generally, philosophically, certainly over the last 2 or 3, you can argue 5, 10 years, increasingly a lot of these technology companies, healthcare companies, where are they residing? They're not residing in the UK or even Europe. It's very much China focused, the US focused still. And not only that, a lot of these companies are increasingly private. They're not even coming to the market and being listed in relevant exchanges. So one can actually access them through different other vehicles, whether that's an investment trust or other closed-end fund structures. So therefore, the returns that one would expect through an EIS strategy, whether that's in technology, healthcare, one can easily replicate or get even higher than in other strategies that are less riskier than, more diversified than, but you know, clearly exposed to areas like the US or China, for example, where one can get and has got returns of 50, 60% consistently for the last few years in that respect. It's something to bear in mind, that dynamics of money flows, capital, and where is the real expertise in the sectors you mentioned at the start: healthcare, technology, health tech. Is it in the UK or is it more elsewhere in that respect?
Okay, thank you for that. Dan, you had to say something.
I was just going to add one small thing there. You know, something I think is quite exciting right now is that I would expect to see advisors, you know, or specifically their clients, looking at more specialist sectors on a go-forward basis. You know, what we've seen over the last 6 to 12 months with COVID. There've been some very clear winners, you know, and there are specialist sectors that have done particularly well, and there's been, you know, a seismic shift in the way we all conduct our lives, and you know, that really has accelerated the curve in terms of adoption of technology in certain areas. So as we've seen historically from, you know, global crises, higher end clients do like to speculate on what the future looks like out of that, and some great returns do come out of that. So I would like to think that advisors and their clients specifically are going to look across some of the specialist funds now and look at where they can sort of deliver returns, and maybe not take the lazy option of just going into the very substantial generalist fund that they have done for the last 5 years.
Thank you for that. I'll move on in a moment. Just Matthew, in his note to me, asked two other questions. One was what more education of advisors can be done, and I'm going to talk to Issa about that and what might be achieved there. And he also asked, could the independent reviewers help with this, to give more of a specialist look at the specialists that are coming out? And I've started talking to Hardman about that. So hopefully you'll see some answers to the questions you raised there, Matthew, but thank you for your questions.
If I could add one more thing, please, from
yes,
just from a financial planning point of view. This is particularly for smaller financial planning firms that don't have as many committees as we have. But I think it's important that when you get to know your clients, and when you talk to them about their interest, when you talk to them about different technologies out there, or whether that's educational technology or medical technologies, or, you know, all sorts of things around the new economy, basically, you'll be surprised as to what they come back with. And so, to some extent, when you're building an EAS portfolio for your client, yes, it could be that you start off with a core holding of maybe one or two generalist funds that are well capitalized, very large firms. You don't have to worry about irregularities from a governance point of view, et cetera, et cetera. But then you beef that up with a selection of specialist fund managers that actually achieve some of the interests your clients have in what are really exciting, really interesting businesses. The last thing you want to do is obviously give them just another boring fund that happens to have tax relief. So it's get to know your clients, match the funds to your client, and then you can create something really interesting.
I mean, it's interesting because Matthew made an example on that which supported that, and a doctor wanted a health tech fund to invest in because it's a world he knew. So I agree with that entirely. But time is going on. Well, we have promised to go on for no more than an hour, so I'm going to move on. When we held the last event, I think it was 6 months ago, for the New Entrant Network, we touched on very briefly at the end of it about the importance of custodians. And there was quite a very interested and heated debate on it at the end. And we wasn't enough time for it, so I want to make sure there's time today. Paul, you've started talking about custodians. What due diligence do you think should be done on a custodian?
I think it should be quite extensive, and I think there should be, apart from the initial, when the fund manager is actually looking for a custodian, there should be ongoing, and that should be done at least on an annual basis. So the first thing that the fund manager should be checking, they should be going straight to the FCA register, is does the custodian have the necessary permissions to actually hold the money? Then after that, look at the company itself. Is the custodianship an integral part of the company? Is it essential for the company? Is it important to the company that they are a success? And then look at the turnover and the profitability, because what you're looking at here is the long-term stability of the company. So what you should be looking at is not just the past accounts, then try making some form of a cost profit forecast that there will be around in a couple of years' time, and they have the strength and the balance sheet to support their activities. One of the other important things you should be actually looking at is the protection of personnel's data. So one of the first things I would look at is the company ISO 27001? That's some form of, that is a nice kite mark, a form of accreditation that they actually understand the security of not only data, but also how to look after it. Because normally the fund manager is the data controller and the custodian is the data processor. So what is actually happening is the fund manager is basically outsourcing and passing across to the custodian the actual managership of the personal data. And along with that, you must make sure that they're actually registered and have a data registration number with the Information Commissioner's Office, so they're actually allowed to actually hold the personal data. Then one of the things I would actually check is, can that custodian deal with listed and unlisted stock? At the present moment in time, the fund manager may just be investing in unlisted stock, but you may pick an absolute winner where the company actually comes to the market. And it's always good to have a custodian who can actually deal with a successful company going from unlisted to becoming listed. And what you want to check is, when you're actually talking to them, do they have the knowledge and qualifications to actually support you, the fund manager, in your mission of trying to get to be as successful as possible? So there is qualifications within the EIS world, and that's one of the other things I would actually check. But also what you need to check is, with the frontline staff that will be dealing with you on a regular basis, just see what the quality of the individuals are actually like. Are they amenable and friendly on the telephone, or when you actually go to visit them? And if it just wasn't for this COVID-19, I would actually undertake a visit to the actual site to see what they're like in their own work environment, and then make sure that nothing is actually outsourced to somebody else, because you don't want to outsource your custodianship to somebody who then is outsourcing it to somebody else. You want to be able to talk to the people that are actually doing the work, actually looking after the assets for you, whether that be the cash or be the certificates and share certificates. And
sorry, go on.
Sorry, and those are just the initial things I would be doing, but I would be doing that on an annual basis. We do that on with our partners, etc. We're always doing checks upon them, and overall, I would ask their compliance department whether they could actually provide an overview of their CAS compliance overview documents and whether they've made any breaches, and how they report them as well. Okay. Back to you, Martin.
You touched on the demise of Breaker earlier, and they were quite a significant player in the market. They were well known, they're well used. What do you think the industry actually learned, or has the industry learned from what happened there? Because I know that several managers were somewhat embarrassed and frustrated because money was held up for, as you said earlier, for a long time.
Hopefully the sector is learning more and starting to learn lessons from that. And what you're starting to see is reports that should actually be done by Churchill and Hardman, is they're starting to identify who the custodian is. And part of that, I hope, is going forward, is there should reports actually be done in greater detail upon the custodians, their financial stability, and also do they have all these qualifications and that I was actually talking about, so such as ISO 27001. And going on is, do they have Trustpilot feedback from investors on are they amenable, are they friendly, and are they professional in what they actually do? But I think the sector's got to learn more. It's just not about the fund manager and the providers, it's about the support services, and that's not just the custodian, it's whether they're outsourcing any of their legal departments as well, because that makes up the whole picture of the actual fund.
Okay. Gentlemen, do the rest of you agree with that? Anything to add? I mean, certainly on the advisory side, do you agree with what Paul's been saying?
Yeah, we've had clients that were stuck in various funds with Riker. I'm aware of some horror stories with AIM portfolio services where nobody could deal. So there's definitely an issue. Having talked to a few managers that changed custodian afterwards, asking about the due diligence process that they had to go through to select a new custodian. Some feedback was more worrying, whereas some other managers gave some really good feedback on how they were going through that process now. So yeah, it's a mixed bag, but I think to some extent, a lot of managers just wanted to get a new custodian in place very quickly.
Okay. Yep. Safdar?
Yeah, I mean, I would agree with the rest of the comments there. I mean, I think it's important due diligence across the whole value chain, from fund to team to strategy to custodian, even banking relationships needs to be undertaken at a very detailed level. And it's not only the due diligence, it's the opportunity cost of getting stuck in, for example, Martin, Ricard securities, and having your money locked away or cash locked away for many months and not being able to participate in other market trends. And as we know, this year the market's been highly volatile and moving in various directions. So there's a number of factors at play here. So it goes back to the point about do your due diligence. If you can't do it yourself, certainly outsource it to the best in class that can do so, and come back to you. This industry is heavily regulated, but I do sometimes wonder if there should be more regulation around some of these aspects, because still there's cracks, there's issues around mis-selling or illiquid securities, and basically pure custodians, whereas Ricard or a few others I can name as well in that respect. It's sad in this day and age.
Yeah. Okay. Well, thank you for that. Let's bring Dan and Boyd back into the conversation now and move on subject a bit. Look, both of you see or talk to, work with a load of fund managers. So you've got a lot of knowledge about what the market is doing. Are there any particular points that you would share with us on what to avoid, what mistakes to avoid by fund managers if they're trying to get traction in the market?
I would almost repeat what I was saying earlier, in that try not to be too general in your proposition. I think it helps if you're very specific in the target market you're going after. And just to add to that, I think very clear examples of the pipeline of investee companies that you're targeting always helps. That you're very crisp in portraying that and conveying that, and giving very specific examples of those type of companies that the fund would be investing in. Also providing records of previous exits or investments that you've carried out would be very helpful, and what makes your fund unique and how it can be marketed. So what I'm saying is that those are the benefits, as opposed to, the pitfall of being too general. I'm sure Dan could elaborate on that.
Yeah, well, I mean, from our perspective, I think, what to avoid is probably complacency around raising capital. I think everyone's been very clear here that whilst it's not right, it is, it is difficult for new startup niche funds to raise the money in the first few years. So to cover a lot of the points raised, be very clear on your value proposition. Get out there and speak to high net worth seed investors. Get out there and speak to advisor firms that are maybe less substantial, in that they're not bound by some of the panel issues in the early days, and a bit more entrepreneurial themselves, where they can match your fund to specific clients, as we touched on, and kind of do that legwork there. Engage with platforms like ourselves, other platforms out there. Use every tool you can to raise that early money, because without that, you will not build the track record, obviously, and it's very difficult not to hit minimum raises and adequately deploy across the portfolio. So that's only ever going to impact, the performance of that portfolio. And I guess just, a few additional things is where we see younger, newer niche funds coming into the market with more success. As Boyd touched on earlier, I think the type of entrepreneurial advisor that will be more likely to invest in your fund is going to want to understand how you work with the companies, how you select them, but also kind of look at the underlying investments themselves. And in many cases, the more entrepreneurial advisors may invest themselves first with a view to bringing their clients in a second or third fund. So be very transparent. If you can provide guaranteed or close to guaranteed deployments that fits around tax years, then for some advisors that are actively planning tax, they need to know they can get deployed before 5th of April or certain dates. That's a really important way that you can differentiate as well, because the larger generalist funds that are out there that don't struggle to raise capital tend to be on quite long deployment timescales. So if you can build a portfolio to show the advisors and show them a guaranteed date that you're going to deploy, that will add value, I think.
Thank you very much, Dan. Well, it was running out of time. 2 questions before we close. The first one is this: what's the best forms of communication in this strange COVID world when you can't meet people? But what's the best form of communications that fund managers can have, particularly with you, Safdar and Avard and Dan? What gets through to you? What strikes a chord?
I mean, for me, nothing beats a nice, well-constructed email with a short, succinct, and focused slide deck, introduction to the company, introduction to the strategy and the team, and then articulating that in a slide deck with the email. I think that's quick and easy to do, and quick and easy for us to read and then mull over. Thereafter, if there is interest, we can then take it to the next stage through a direct meeting or a conference call, Zoom call nowadays, or whatever is necessary thereafter.
Terrific, very concise. Exactly that email. Thank you. Yeah. Avard.
I think in addition to the usual, obviously email important, but I think something that we've started doing now with a couple of funds is where we've had joint meetings with other analysts. So that makes good use of time, but also you combine experience of other people looking at the fund. So that's been with 1 or 2 firms. We've had some successful sessions already. So that helps. I think it's have a communication plan with the people that you work with as a fund manager, where you commit to quarterly or half-yearly updates, and where you just make sure you stick to that. I was also going to say that in some cases there are funds that complement each other. Especially sometimes there are promoters out there that combine several EIS funds. So again, there's nothing stopping you from hooking up with a couple of other EIS managers and do a joint presentation and present yourself as a diversified portfolio immediately. Obviously without giving a recommendation here, but it does help. It's
helpful, really helpful. Thank you. And Dan?
Yeah, so I guess for us, it's less about how they communicate with us and more about how we can assist the funds in communicating with our advisor client. So, I've already touched on the fact that by coming onto a platform and being visible alongside all of the bigger names is a first step. With the younger funds, the more information they can feed into us that we can disseminate across our marketing to our clients and through our client services and sales team, the better. And specifically, We run a webinar series that we have done for a number of years now. That was the first online webinar series, but it is obviously now there are many, but we've got a huge following across the advisor marketplace. I think many of the people on this panel have been on the show, but it's a really good forum for funds to come on, talk about their value proposition, we get hundreds of advisors viewing it, both online, real time, and on demand, and we're able to share that video footage with the providers so that they can push this out through their own channels into the advisor universe. So that's a really good way to get noticed early on.
Thank you. And I'm going to throw one last question in now, only because I'm interested in it. For my sins, I actually chair a committee for ESA, and something we've done recently is launch some new principles on fees. One of our viewers today has picked up on that and said it's gone down really well, but what does the panel think as to who should be paying the fees? Should it be the investor? Should it be the investee company? Or should it be a mixture? And so as a last question, I
would go for the investee company purely from the tax efficiency. That would be, I want everybody to answer, but that would be my view.
Okay, I could counter that by saying it means there's less to invest.
You could do, but then if you take the fees directly from the investor to begin with, there's less to invest. So,
indeed, fair enough. Any other views?
Just be transparent.
So it doesn't matter to you.
That's essential. Be completely transparent about the charges that you levy, either on the client, the fund, the companies, whether that's upfront, whether that's ongoing, whether you charge all your ongoing charge fees upfront, because that's also a model that I've seen. Be transparent about whether you are related party transactions, i.e. where an investment management team may be separate from the fund management team, and there's fees that go outside of the fund prospectus. That aren't, so just be transparent, because investors can make up their own mind. They know obviously the difference between 100% qualifying and 94% qualifying. We've got clients who will just put in a bit more money. Just be transparent. That's all.
Okay. Safdar, do you want to add anything?
I mean, the only thing I would add there is, again, transparency is important, and competitive. Just be competitive fees as well. Don't expect to capture large fees for what could be a fairly unique niche strategy, or you're an emerging manager yourself in this space, or you don't have a track record in that respect. So you have to have skin in the game, for want of a better word, and be competitive around fees as well as clearly transparency is a given, very much so.
Yeah, I'll add to that is that there are increasingly funds who do not charge portfolio companies, simply because they are moving, or they operate in a space where they co-invest, syndicate with other non-EIS managers, where if they start charging fees, they're left out of the room. And so there is something to keep in mind, clearly, that if you charge portfolio companies, you may not always get the deal that you would like.
Thank you. Interesting.
But that's anecdotal as opposed to research fact.
But I can actually echo that. I'm actually was having the conversation with a fund today on the competitiveness of what fee they charge the investee companies, and it was that very point. If it was too high, they felt they were missing out on deals. So yes, I mean, the fee has to be both transparent and justified for the work they're doing and competitive in the market. Absolutely.
Yeah. Again, great insight. We've run out of time, and I don't want to hold up the audience or even our speakers. So can I just finish by, first of all, thanking each one of the panel for coming along today. I really appreciate having you here. And can I finally thank Hardman for putting this on and hosting it. It's been a lot of fun and very interesting. But thank you to all of you. Thank you.
Thank you.
Thank you.
Thank you.